All right, thank you everybody for joining us. My name is Shane. I run the events over at 10 Capital Network, and we have a great event for you today. We're going to have our reverse pitch with Martin Tobias from Incisive Ventures, and then we're going to have a couple founders come after that and talk to you about what they're doing at their companies. If you have any questions throughout the session, please drop those in the chat box, and we'll get to them when we can. And with that, Hall, I'll let you introduce our first pitch.
Great. Thanks, Shane, and thank you guys for joining us today. Today we have a great pitch from Martin Tobias. He's the founder of the Incisive Ventures Fund, and he's going to give us his pitch and investment thesis behind the fund. Looking forward to your questions there in the chat box and looking forward to the follow-up discussion here. So with that, let me pass it over to Martin. Martin, if you'd like to go ahead and kick it off, tell us more about Incisive Ventures.
Okay, sure. Can you guys see my slides?
Yes.
Does it work? Okay. Hi, thanks for having me. I appreciate it. I'm Martin Tobias, founder of Incisive Ventures, and we're a $10 million pre-seed fund in Seattle. Let me see, how do I move this forward? Oh, there we go. And we focus exclusively on pre-seed, which I define as a company with an MVP already in the marketplace, a couple of customer interactions, $5,000, $10,000 worth of revenue, and you're really trying to get to that $500,000 of ARR. We invest exclusively in technology companies that we say reduce friction at scale, and I'll talk about some of my prior investments. I've been investing for about 25 years. I was an early investor in DocuSign, for example, and that's a perfect example of a software application that took a physical manual process that people did millions of times a day and did it with technology. We've been investing for about the last 3 years on this thesis, and our companies in the last 3 years have raised about $2.5 billion of follow-on financing. One of the primary things we do as pre-seed investors is focus on investor introductions to our pre-seed companies, so that, because basically you're never creating a profitable company in pre-seed, you're just really getting ready for the next round, and we have a pretty good track record in doing that. So about me, I'm a computer nerd. I majored in computer science and business at Oregon State University, and went to Anderson Consulting and Microsoft early, and really started investing in startups as an angel at Microsoft because I was working in a group that was working with startups, and I noticed that the startup people were having a lot more fun, it seemed like, than I was. So I'm like, maybe I could invest in those companies. So I started doing that about 25 years ago. I'm also a limited partner in about 17 venture funds, but I started investing sort of full-time about 3 years ago. And that's when I started an angel list syndicate. We've deployed about $15, $20 million on that, and a small angel fund last year of $2.5 million. And now we're investing out of our second fund, which is a $10 million fund. I was also for a while a venture partner at Ignition Partners, which has $2 billion under management. But one of the things that I think a lot of founders appreciate is that I'm not just an investor. I've been an entrepreneur for about 25 years. I was 3 times a venture-backed CEO. I took 2 companies public, raised over $500 million myself, including IPOs. So I really have an understanding of what it means to be in the CEO seat and how the combination of the investor CEO thing works. So I think a lot of founders find that helpful. The track record, as I said, the last 3 years we've been investing, we've made 66 investments, 4 of which turned into unicorns. I was an early investor in Jeeves, which is a fintech out of Latin America, Deal, which is the employee platform. I was a pre-seed investor in OpenSea. Its last valuation was 13 billion. I have no idea if it's worth that much today, but I was in around at 20 million pre, so our investors are doing very well there. And I was also an investor in Papa, which is also a unicorn. The number that I'm most proud of, though, is that 73% of our pre-seed companies have received follow-on seed or Series A rounds. And if you compare that to your normal pre-seed investor, if you look at PitchBook or Crunchbase, most VCs that invest in pre-seed would get about 30% of their pre-seed companies to receive follow-on financing. So we have a whole bunch of internal tools, and the fact that I've been in the business for so long and I'm in so many funds and know 300 GPs directly, that's why we're able to get follow-on financing at a much higher rate than a normal VC. Our thesis is around reducing friction at scale. And one of the ways that I figured out that thesis is at the beginning of the pandemic, I went and looked at what some of the most successful technology companies were. And if you look at them in technology, they have all mostly been doing this reducing friction at scale. So, the friction Microsoft did was, better applications to perform your desk work. We talked about DocuSign making contract signatures easier. Amazon has been all about reducing friction, delivery to your home, one-click ordering, who bought this, bought that, third-party sellers on their platform. It was just a less friction environment than having to get in your car and drive to Walmart. And it created a significant more enterprise value than traditional retailers. There's a lot of companies like Plaid that reduced friction in fintech apps. If you look at the entire fintech ecosystem, it would not be as big as it would be today if there weren't this middleware API layer in Plaid that makes developing fintech applications an order of magnitude simpler and less friction. OpenSea, while I don't invest in crypto, I do invest in marketplaces because marketplaces reduce friction. They help buyers and sellers find each other. They create liquidity for an asset class. And my bet in OpenSea was marketplaces like Amazon and eBay can be great businesses. So, that was the bet in OpenSea. And let me see. So some of the opportunities and tailwinds that we think are going to drive and create lots of great innovative companies over the next couple of years is, as you guys probably know, cloud everything, remote everything, AI and ML everything. We are not investors in the core AI models, like the big data models. We believe the core AI technology is going to be owned by people like Microsoft and Google and Amazon. But what we're big believers in is specific vertical market applications of AI. And we've made a couple investments there where you're using AI to solve a particular problem. I just invested in a company last week that is taking, for example, real estate agent leads and in adding data and using AI to figure out which leads have a higher level of intent. And they're quadrupling the conversion rate in cold outbound emails by targeting higher intent buyers in the lead database. That's a specific application of AI, which increases the conversion rate in things like direct email. And so we love vertical market software applications. If you look on a meta level, things like Excel, general purpose tools like Slack, like databases have done a lot to improve productivity, but the next wave of productivity in businesses are replacing some of those general tools with specific tools. So for example, I did a company that was created a vertical market software application that helps manage private airplanes like NetJets. And those companies were using spreadsheets and fax machines to manage the operations of their airplanes before. And this company created a specific application that did all those things much more efficiently. I think we're going to see a big wave of companies writing specific applications that solve specific business problems that replace a lot of these general purpose tools that was kind of wave one of technology adoption, things like spreadsheets. The industries that we tend to see a lot of friction in, that we think there's a lot of opportunity, we're a generalist software investor, so we don't have specific verticals, but we tend to see a lot of interesting friction opportunities in health and fitness, fintech, insurance, real estate, and supply chain. Industries which are somehow laggards in current technology. And it's interesting, companies like health and fintech, they were early adopters on technology, but now they're laggards. You're sometimes replacing, mainframes in fintech. Anytime somebody's running a mainframe, I love companies trying to replace mainframes because those things are 40 years old. So why do we think pre-seed is a great opportunity now for investors and for founders? The valuations, I think, have been reset. Some of the founders on the call may not like the fact that valuations this year are less than last year, but they're back to sort of normal rate levels, and we're not in this bubble environment. And I think that is more sustainable for company formation over time. There's also a ton of talent available. If you look historically, after a couple of the times that busts have happened, like 2000 and 2008, company formations actually go up, because when people get laid off from big tech, a lot of them are like, hey, maybe I'll start a company. And the competition for startups, among startups for talent, is less. So it's easier to recruit people. And if you look, some amazing companies have been created in downturns. eBay, PayPal, Amazon were all created right after major market corrections. And in this kind of environment, I do believe that investor experience matters. I've been through at least 3 major tech cycles, and understanding how these cycles play out and are likely to evolve is something that a first-time or second-time founder who has not been through some of these cycles can really benefit from. And I would encourage founders to seek out investors who have been through some of these cycles before. We just came off roughly a 10-year bull market in venture capital, and many people who have started companies there don't know what a downturn looks like. And you can get that experience with the right kind of investors. And now more than ever, follow-on financing connections, which is Incisive Ventures' superpower, I believe, are more important. The number one risk to pre-seed companies raising money today, I believe, is follow-on financing. Until November of last year, we were in an environment where companies could pretty reliably plan on raising money every 6 months because capital was very free and very open. I think most people who are in the market trying to raise today know that it's a very different market. AngelList said that their volume is down 80% in terms of angels writing checks on AngelList. So what that means is that the investors who do invest in your company, it's going to be very important. Do they know other investors, and are they connected to other investors to help you get that next financing round done? The connections of your shareholders are more important than ever, because warm introductions are what's going to get your next round done. And I just wanted to give you an example of some of the value add that Incisive has provided. Whenever I write a pre-seed check, one of my criteria, and it's not the same for every pre-seed investor that I've seen, I want to know, and I identify in my network, at least 3 follow-on investors that I believe would be interested in this company if it achieves its objectives in the pre-seed round. And I know that because I talk to them regularly. I know what their criteria are for a seed or a Series A investment. And I know that they will be willing to take a meeting if the risk I'm underwriting in the pre-seed turns out to be correct. I've written a bunch of proprietary fundraising tools to understand the environment and to make those introductions. I've also been in the CEO seat raising over $500 million, so I understand very deeply what it takes to raise follow-on financing. And the proof's kind of in the pudding. Of the $20 million that we deployed in the last 3 years, those companies have raised a combined of over $2.5 billion. Not all from my introductions, but directly, but certainly that's a pretty substantial sum of follow-on financing that my pre-seed companies have done. And I'll give you an example down at the bottom. I invested in this company, Catalyst. I put in $500,000 in March of 2021. I led the pre-seed at a $10 million valuation. We helped them raise some additional capital in April, some additional capital in June. And then in November, we put an additional $1 million into a $25 million Series A round. I introduced them to 5 tier 1 Series A investors. They got 5 term sheets. They ended up taking one of them for $25 million. And then most recently in August of last year, they have since closed a SAFE at a $200 million valuation. So in roughly a year and a half, that company's worth, 20 times more than we invested, and largely from the power of our introductions to follow-on financing. Let me just talk a little about how we source deals. Roughly about 30% of the companies get introduced to us by other VCs. About 30% come from founders and former employees that we funded before. About 30% come from sector outreach, where we're interested in a particular category and looking for companies. And about 10% come from accelerators, as well as we get about 300 companies a month that come in through Twitter and our cold inbound. We take roughly 25 meetings a month, do diligence on about 10, and invest in about 1 out of those 300 every month. And that's the sort of overview of Incisive Ventures. We're very excited to partner with innovative founders, love SaaS software, love B2B software, and are really excited to hear some of the pitches today, as well as take questions from anybody in the audience about the venture ecosystem or whatever you might have.
Great. Thanks, Martin. We had our first couple of questions come in, and the first one is, the cost of refinancing residential real estate is way too high. Is there anybody out there with a breakthrough there?
Cost of refinancing residential real estate? I haven't seen anything great in that, no. That's kind of a odd question. The primary driver in that, of course, is the new interest rates. And I haven't seen anybody trying to innovate there. I've seen some companies trying to take out closing costs, but that's not a material part of the business.
Great. Next question is, if you're investing in such early stage companies, pre-revenue, are you using mechanisms such as convertible notes and safes at that or any stage?
I actually just wrote a post about this. Basically until November of last year, almost every company was proposing a SAFE, and the companies were suggesting what the terms were. And companies were sort of setting the terms, and VCs were price takers as opposed to price makers. In the last 8 months, I've seen that change, and I have actually renegotiated a couple things. Personally, as an investor, I prefer a convertible note to a SAFE because it has some additional protections for investors. It's not materially different for companies, but it's better for investors. So typically in pre-seed, you are doing a SAFE or a convertible note. You're probably not doing a priced round. The first priced round is typically the seed round. I'm also, right in this environment, very sensitive to the amount of SAFEs and convertible notes relative to the future financing. And my recommendation is that companies not raise on SAFEs or convertible notes in the pre-seed or the angel round more than 25% of the total capital that they expect to raise in the seed round. So for example, if you wanted to, if you think you want to raise $5 million in your seed round, you should probably not have more than $1.5 million of SAFEs. One of the problems I've seen in the market now is people that have $4 or $5 million of SAFEs and are trying to raise a $3 or $4 million seed round. You've got too much SAFEs relative to your fundraising, and it creates a complicated cap table. So one thing I would encourage companies to do is to try to pay attention to how the quantity of SAFEs they do prior to a priced round. And I'm seeing in the market now many more priced rounds starting at the seed, whereas last year the seed might have been a SAFE as well.
Great. Next question is, I noticed the word crypto didn't appear once in your investment thesis. What's your take on that space?
Crypto is a complete scam, and I stay away from it like a plague.
What about Web3, DeFi, and those things, which are less on the currency and more on the technology?
Also a plague. I mean, I don't mean to offend anybody, but I am not the right investor for that. There are plenty of investors who understand that ecosystem. Personally, my thesis is that software should reduce friction, and I have yet to find one thing you can do on Web3 or crypto which is less friction than you can do in Web 2. The one and only product that was crypto native was NFTs. And that's why I invested in OpenSea, is that it was not a bet on crypto or Web3, it was a bet on a new asset class that people might want to buy and sell. And so this is a new thing that you can't buy and sell anywhere else other than on that platform. So as long as people were interested in that asset class, you could make money on it. But I have, Web3 and crypto has been one of those things for 10 years. It's going to revolutionize finance and, be able to tokenize real estate. None of those things are easier to do and have less friction than you can do them in traditional Web 2 areas today.
Great. Next question is, what are traction metrics for the average B2B SaaS pre-seed round? What do you look for to measure traction when they're at that stage?
That's a good question. So I define pre-seed, and if you go to my website, incisive.vc, I just posted a blog post that defines the angel versus pre-seed versus seed versus Series A and has traction metrics in it. But generally, the way I define pre-seed, and other investors may have different opinions, but is you've got the MVP done. You've got, it's been in the market with customers for at least 3 months. You have approximately $5,000 or $10,000 a month of revenue. If you're B2B SaaS, you've got 10, 12, 15 customers. If you're B2C, you've got a couple thousand users and downloads. Those are the traction metrics I'm looking for in pre-seed. If you have not built your MVP yet and you have no revenue at all, I consider that the angel round. That's not pre-seed in the way that I define it. That's more of a angel round.
Okay, great. Next question is GovTech its own vertical? And do you consider or avoid SaaS selling to munis or govs?
I avoid anybody who sells to the government like the plague, almost as bad as crypto. And the only reason is that it's a two-sided sword, right? I mean, you look at companies like Plantar, and they have made billions of dollars off government contracts. And once you get government contracts, you're hard to dislodge. But the problem is the time selling into those contracts and the non-economic decisions that many of those governments make. They have set-asides for certain geographies or anything like that. I just have found, when I say reduce friction at scale, the government is like the definition of friction. They're slow, they take a long time to make decisions. Your selling cycle going into governments are typically 3 to 5 times longer than selling to private corporations. And they many times do not make decisions based on, ROI or things like that. They make decisions on other factors. So those tend to not be good markets for investors to fund because your sales cycle is too long and you can't get answers very quickly. When you are doing a pre-seed thing, you're giving a company like 18 months worth of runway. So if you've got 18 months worth of runway, you need to be able to sell something in like 6 months. And many governments aren't going to give you an answer for 12 months. And so this is the reason why I tend to stay away from people who sell to governments, just because the sales cycle relative to the funding cycle, there's a mismatch, right?
Great. Next question is, what are some of your biggest red flags in the deal that makes you say no and exclude crypto and Web3?
Okay, you guys got the message on that one. I just did a post on Twitter the other day on red flags in decks, and some red flags in decks do not put in an exit slide. do not tell me you're going to go public in 3 years or you're going to sell this for this. That's a red flag. Not having a unit economics slide in your deck is a red flag. Not having any customer traction and customer retention and CAC to LTV payback is a flag, because it means you may not understand your economics quite yet. But the biggest red flags are, for me, are in pre-seed, there's really only two things that matter. One, the management team and the founders. Do they have perfect product market or founder market fit? Are they the right founders to solve this problem at this time? And the second thing is, do they have a reasonable plan to get product market fit answers within the time of the money that you're giving them? So those are the only two things that matter in pre-seed. So flags would be, you know, like for example, I just did this company which is creating a basically a Slack for construction companies, field workers. And it was, the founder was a 10-year construction manager himself. He owned his own general contracting firm. And he built this problem to solve his own labor productivity problem. And now he's trying to generalize it and sell it to other contractors. That is a perfect founder market fit. A flag would be a founder who says, I started this company because I read a Gartner study that says this market's going to be big. And it's not sort of perfect founder market fit, right? That's the major flag for me, is I'm looking for founder market fit in pre-seed.
Hey. Next question is, do you invest at all in non-SaaS B2B, such as consumer pre-seed?
Consumer pre-seed. I will invest in consumer applications of software. I will not invest in consumer packaged goods.
Okay, great. Next question is, we're looking to get funded a baseball version of Topgolf. Any thoughts to reach out to in the entertainment space funding?
I think that would be interesting. Topgolf is a very successful concept. I do know a couple of VCs that are sports-related VCs. There's companies like Courtside Ventures. There's companies like P72, which is a hedge fund that's owned by, I think, the people that own the 49ers. There's a couple of VCs that are specific around sports-related themes, and you can find them on PitchBook or Crunchbase. I would, you know, try to talk to them. I am not specifically a sports-related VC, but I think those guys would be interested in hearing something like that. The other reason why I would probably personally not be interested in that is that that kind of business is fundamentally pretty capital intensive, because what you're doing is building physical locations and trying to get people to come and pay you hourly rates to do something there. Those kinds of businesses don't scale the same way software businesses scale. So you need to find an investor who likes to do physical high margin physical locations. And there are investors out there who do that.
Great. I'm building my own social media. Imagine Instagram plus Twitter plus TikTok plus Spotify plus YouTube had a baby. For pre-seed releasing before the app right now, you know, right now have Figma demo. What metrics are you looking for?
Well, the first thing, as you probably know, new social networks are, you know, a nightmare to get going, and that, you know, in order to get network effects, you've got to get the flywheel going. So the metrics would be really, what's your customer acquisition cost and what's your flywheel to get customers to adopt your new social network. Having a bunch of features and writing something that works is not the key to that business. The key is, how do you get 1 million people to download your application? That's the only thing that matters for a new social network. And typically, where I've seen people do that successfully is to partner with, you know, schools. I mean, that's how Facebook started, right? They partnered with universities. You've got to have some, what I call thin edge of the wedge, to get your first 1 million users. And it's usually more than just, you know, a bunch of upvotes on Product Hunt. So I think that's really what you need to focus on, is how do you get 1 million users cheaply?
This question is, what are your thoughts on MedTech incorporating AI and ML? seems Catalyst may fit in there. Of course, it's a given that regulatory may be challenging, but what are your thoughts there?
I think there's a bunch of opportunity there. I was an investor in a company called DocBot, which was using AI to analyze the GI scope video feeds to identify polyps in gastrointestinal exams. And the AI was able to do that better than humans could. There's lots of applications in medical. There's already companies that are like using AI to analyze X-ray scans and stuff like that that can do it better than people. I think that is a big area of opportunity. And again, it fits in my idea of reducing friction, because doctors would rather spend their time doing surgery than doing diagnosis. And so I think there's a lot of opportunities in medtech for software. I don't do medtech devices. I only do software, but I think there's a lot of opportunities to improve efficiencies in the medical field with software, especially AI analytics.
Great. Next question is, how should a company balance having substantial assumptions on CAC LTV, for example, at such an early stage, versus acknowledging not having enough data yet to be confident in it?
Well, that's a very good question. And I think I've never found a company in pre-seed that's confident. In fact, most companies that say that I see in pre-seed are like, our CAC is 0. And I'm like, because their friends and family are their only customers right now, right? And they're like, our CAC is 0. And I'm like, how scalable is a 0 CAC? I don't understand. So typically what you're doing in pre-seed is that you started with your friends and family and you have 0 CAC, but you may have started even in a small amount, like say a month or two, doing some Google ads, some Facebook ads, some partnerships, whatever. You've done a small budget, let's say $10,000 of something, of paid channels in say 5 different areas. And what you're doing in pre-seed is you're saying, well, what we're going to do is we're going to figure out which of these 5 trials, things that we've sort of tried, are the one that really works. And that's what we're doing in pre-seed. That's reasonable to explain to investors. You say, we don't know which one's going to work. We want your money to figure it out. But we've done, what you have to do to convince investors to do that is you say, we've gotten some 0 CAC customers from our friends. We've tried small experiments in these 5 areas, and we want to do much bigger experiments because we think that we'll find one that really works. That's completely, you have to be honest to investors, say what you've done, but they will expect you to have done something, right? To at least have a starting point. And then what you're doing is you're saying, let's say you ran $10,000 in ads and your CAC is, $30, and you're selling something that's $100. You go, okay, we want to spend $100,000 and we think we can get our CAC down, or we think the CAC will stay the same and that's fine, but we have to see if we can scale what we've done. And that's basically why we want the money. That's a reasonable request and it's a reasonable test to run. But you need to tell the investors what the objective of the pre-seed expenditures are. And it's a reasonable objective to validate, CAC channels.
Great. Next question is, what are your thoughts about travel tech startups post-COVID?
I don't like them.
Why?
First of all, they're a little bit of a marketplace, scale type thing. Expedia has already got a lot of this. Travelocity. I mean, you're competing against very, very big guys in a very low margin business. I mean, travel is a low margin business. And I think it's very hard to come up with something unique that can scale in travel, or to get people to let you in to their economics at scale, because they already have such tight economics. I just think they're very hard to do.
Okay. What is a good B2B go-to-market strategy?
One that works. Typically, the go-to-market strategy is the second, the first thing in pre-seed is the founder market fit perfect. The second thing is, what is your go-to-market strategy? And go-to-market isn't, how do I get $100 million? It's, who are my first 100 customers? right? The perfect go-to-market strategy is one that has a high degree of confidence to get your first 100 customers. Now, that could be that, you know, the CEO or the founding team came from a prior company that has these customer relationships, and you've already have a pipeline. You have to have at pre-seed a thin edge of the wedge. And hopefully it's not just paid ads on Google. Hopefully it's some proprietary insight or some proprietary relationships that the team have brought from their prior experience. Like, you know, I know this guy who's an influencer and they have 10 million followers on Instagram. He's my buddy. He's going to do a post. And, you know, you've got to have some cornered resource that has a high degree of confidence to get you those first 100 customers. Because if you're just out there blasting Facebook ads like everybody else, you're going to waste a lot of investor money. Investors want to see some cornered resource to get that first 100 customers.
Great. Your thesis on friction is very logical and most probably assume you're focusing on procedural friction. Does your interest extend to software aimed at reducing friction in working relationships or social interactions?
Not as much, mostly because it's harder to peg the ROI on those things, right? I tend to be a hard ROI guy versus a soft ROI. If people are like, my application, you know, is going to improve happiness at work by 10%, I'll be like, that could be interesting, but how much would I pay for that? And I don't understand the economics of that. I don't understand how that relates to the bottom line. If in working relationships and social interaction, you can come up with a pretty hard ROI, I might be interested, but I've found that those things are harder to get a hard ROI on. Doesn't mean they're not useful businesses, doesn't mean they're not, you know, useful tools. It just means that it is harder to convince somebody to pay money for it, which is, in my mind, the most important thing that a startup has to do.
Great.
Somebody has to pay money.
Right. Next question, can you share examples of some recent investments that you made in consumer software applications? What convinced you to invest in them?
So I recently invested in a company called Spare8 in India, and it's building basically acorns for India. And I don't know if you're familiar with acorns, but it's a company in America that lets people round up their credit card transactions and go into an investment account. So let's say you buy a latte at Starbucks for $3.75. It would take those additional 25 cents up to $4 and put that into an investment account and then auto invest it for you into ETFs. We did one of those in India. Obviously, the numbers are very different, but they're rounding up from different payment methods. And rather than investing in the stock market, they're buying gold because Indians love their gold. So it was a little bit of a localization of that business model, but it's basically a low-cost, small dollar consumer investment platform. They have about I invested when they had nothing. Just an idea in an incubator. They now have 120,000 consumers. They're growing 30% month over month. They're crushing it.
Great. Next question, what was your biggest failure and what was the cause?
That's a really great one. So my biggest failure was not necessarily my fault, but it was a timing thing, and that has really informed me about how I invest and how I think about where we are as an investor and a founder in the overall business cycle. So I started a company in 1997 called Loudeye Technologies. We went public in March of 2000. We went public March 17th. The peak of the NASDAQ, the dot-com bubble, exploded March 21st. So we were the absolute last company to go public in the dot-com boom. Now, we got our $120 million in our IPO, but our stock in the next year basically lost 97% of its value. I lost $400 million in a year. But it was also $400 million that wasn't really mine until the IPO, right? So that many people could say that's a failure, but it was the macroeconomic environment. When the dot-com bubble burst, every dot-com company, got reset in price. And, when you look back at it, when we went public, we had a $2 billion market cap for a company with $10 million in revenue. That was definitely a bubble valuation, just like many crypto companies. And, we've had a correction recently, of 60 to 80% in public market companies as well. And many of those companies are not terrible companies. It's just that investors got tired of paying bubble prices, and now they've repriced them to more of a normal price. So while it was a failure on dollar values, it had nothing to do with execution in the business.
Right. Next question is the residential real estate market efficient when agents still charge 6% commission? And how do we remove that friction?
That is one of my favorite questions. I actually invested in a company that was trying to solve that. I want to hear any idea anybody has for this. If you look at America, that is a huge amount of friction, and it's locked in place by a bunch of regulatory capture. I mean, there are actually laws that make it illegal for real estate agents to charge less than 6% in some states. It's crazy the amount of lobbying that industry has done to keep them in there. America has the most inefficient transaction in real estate in the world. If you look at that 6% on the trillions of dollars of real estate transactions, it is a crazy amount of money. In Australia, the average house, the average transaction cost for a house is 1% total, wow. Not 6%. And if you just look at the tax that is on the Australian economy versus the tax on the American economy, it's a crazy amount of money. So I invested in this company called Doorsy, which in Spokane here, and they were trying to let people do auctions to figure out the actual price. It was a bubble type thing based, last year when every house was, a bidding war. They were trying to make more efficient the bidding process to figure out the true price of a house. And they thought that they would start with that and then move into doing the transaction for like 2%. But there is just so much built-in inertia from the agents and the lobbies and the laws and the governments. It was very difficult for them to charge any lower amount. They literally, there were 32 states where it was illegal for them to charge less than 6%.
Wow. Great. Well, this is our final question for the panel here. Do you invest in health tech, and what would you look for?
I do invest in health tech. I would look for a software company that does something that improves health outcomes. I recently invested in this company called PearSuite, which is a patient engagement platform, and it improves patient compliance with medications and improves emotional well-being scores and things like that for patients and health systems. So anything which is software that improves health outcomes, that has some proven ROI, I would love to see.
Great. We'll go ahead and connect you with the people here that have questions afterwards. With that, let's go ahead and move over to our first presenter today. Thank you, Martin, for your feedback and your pitch there, and looking forward to your feedback on these presenters. First up is Tim Southerns of Digital Water Solutions. Tim, let's go ahead and have you come up and launch your pitch. And Martin, let me know what questions you have. And also in the audience, you can post those as well. For those questions we didn't get to, we'll match you up with Martin afterwards for follow-up.
Great. Thanks, Hal. Thanks, Martin, for that. Right away, just so you know, right off the bat, this is a government pitch. So we're done now, but I'll love to talk to you about something else in the future. Anyway, Tim Southerns, President and CEO of Digital Water Solutions. We recently won the award for the vendor to watch at the Smart Water Summit in 2022 in Florida, and we were named one of Canada's 50 top clean tech investable opportunities of last year. Digital Water Solutions helps people understand what's happening underground in their water networks and municipal water systems. So what's the problem? Well, our customers are water utilities, and they have pain points around water loss, water main breaks, low system pressure, the ability to see leaks in PVC piping, and the ability to adopt technology seamlessly. The cost of this to the North American industry, well, water loss costs between 14 and 18% of all water that is treated and pumped. That costs about $4 billion US just in electricity costs on an annualized basis, not considering chemicals, not considering labor and overtime associated with the production of water and the repairs to the water mains. Breaks occur frequently. In fact, 850 water mains break daily in North America. City of Toronto, of about 2.7 million people, so not a large city by US standards, has about 1,100 breaks annually. These breaks cost the US economy about $8.5 million per day. In terms of low system pressure, well, when you go to fight a fire, when you go to have a shower, when you go to take a drink, people don't like it when there's no water pressure in their system. Being able to monitor that and respond to that in a quick and effective way allows us to fight fires, continue to enjoy the water that we do, and avoid compliance issues with regulatory bodies. The ability to see in PVC pipes is our unique advantage. Our technology is the only one that actually sits in the water column, detecting leaks from within the pipe as opposed to outside the pipe. Now, most water utilities in North America today have mixed pipe networks, PVC, iron, metal, concrete. In fact, where I live, we just took our last wood pipe out about 15 years ago. Our technology is able to see in all of those pipe materials. In terms of technology adoption, most water utilities don't want to spend over $100,000 employing somebody to work with the technology that they've just purchased. In terms of the state of the industry, well, most of our competitors are in what we call the lift and shift mode. They deploy their units on those little blue dots, the valves on your front lawn, the fire hydrants, and they take a snapshot in time of the system looking for leaks. They're typically listening acoustically, as they call it, for vibration and noise that is resonating from the pipes themselves. Our approach is different. We're looking to put way less instruments in the field. In fact, one for each red circle that you see on the map, equivalent to all those little blue dots from the lift and shift companies. The difference also is that we're in the water column. We're permanent, 365 days a year, 24 hours a day, listening to the noise that leaks generate in the water system. So why spend time on lift and shift when you can have year-round coverage? Yes, we have competitors who are doing leak detection, Ecologics, Camstrap, iHydrant, Fido, Gutermann, not only in North America, but globally. Some of the distances are covered by them are quite small by comparison. So our offering is a core technology that consists of both hardware and software. We have sensors and an agnostic platform that we've built. In terms of our sensors, we actually locate them in the water column. So we use fire hydrants. There's no digging required. There's no valve chambers. There's no road interruption. We simply install them into the fire hydrant, connect to the cellular network, and start collecting data within 5 minutes. We've already built these sensors for 3 of the major manufacturers of hydrants in North America. And on Monday, we installed a pilot for a 4th manufacturer. And next month, we hope to install a pilot with yet another manufacturer of hydrants. Because manufacturers of hydrants can be potentially an OEM supplier to the market for us. In terms of the platform, our data arrives at our platform where we have our AI and ML models running. Uniqueness about this is it's completely autonomous. We're not concerned about the type of data we receive. So while it's designed for our devices today in terms of the acoustics that we collect from the water column, or whether it's the pressure or the water temperature, we can also ingest other data sets and run our autonomous AI against them. In fact, we're at a point now where our AI can detect pre-existing leaks in the system, not requiring a large amount of background data to be processed before we can generate results for our clients. Once these results are generated, we immediately alert our clients to the situation, allowing them to respond rapidly to leaks or breaks within their distribution network or changes in their operations. Moving forward, we've envisioned our platform as being a platform for data integration from multiple applications that water utilities run, whether that's their control system or their GIS system, perhaps it's their metering system at the customer side. Being able to pull that data in and apply our models to it just increases the value that our customers will receive from this solution. Some of the benefits. Well, when we've run ROIs for some of our clients, if we can find those leaks early and reduce water usage by 50%, that alone in the US would save $2 billion a year in electricity costs. For a city like Toronto, when we've run the calculations, even after paying for our installation and our devices and our technology, they would save over $8 million a year in lost water. In terms of water main breaks, what if we could reduce them by identifying leaks early, avoiding having to shut down businesses, flooding of basements, washing cars down the street? We could save up to $5.5 million annually for the city of Toronto. In terms of low system pressure, nobody wants the regulators showing up. Nobody wants the EPA on their doorstep asking them why they have low system pressures and what they're doing to correct that. Nobody wants their customers calling and complaining, and certainly nobody wants the fire department not to have water when they arrive at the hydrants. In terms of visibility in PVC pipes, because we're the only technology that does this today, and because in North America, all water networks are now mixed pipe materials, we see this as a unique opportunity for our technology in this space. In terms of technology adoption, we envision our technology as plug and play. We drop it in, data arrives at our platform within 5 minutes. Alerts are started generating immediately upon receipt of the data if it's out of compliance. In fact, we ran a pilot last year. One of our clients who's been looking for leaks in his system for over 16 years put our system into a hard to detect leakage area of plastic pipe. We were able to find 100% of leaks that he generated in the pilot trial. So as he simulated leaks, our technology was able to identify them and locate them within the network. As he said, it was pretty impressive given for 16 years, he's put devices in that even when a leak was 10 feet from them, they couldn't detect it. In terms of traction we have going right now, we have over 25 water utilities that have begun the process of deploying our technology. Does that mean it's complete within those? No, but certainly the uptake is increasing. We have some large utilities such as the City of Toronto and City of Montreal up in Canada. We also have the City of Atlanta in Georgia. And just recently we installed a pilot trial. And when I say pilot, these are paid. We don't do anything for free. In Milwaukee Waterworks. We also as far west as White Rock, British Columbia. And in fact, we have installations in Iceland with the local operating authority there. The market size in Canada and the US, based on the EPA and the government of Canada, there's 155,000 water systems. In terms of the ones that we're targeting, there's about 52,000. These are the ones that are permanent residential systems, not campgrounds and trailer parks. We see a market of about $104 billion with $5 billion of ARR available for us. And while we're in water, we also know our technology will work in other fluids. So we've had investors ask us already about the ability to use our technology to detect leaks in pipelines for oil and gas. Currently, our lines of business, it's called Hydrant AI. It does leak detection and localization, transient detection and localization. It monitors pressure and water temperatures within distribution networks. We also provide commissioning and project management services for the water utilities that require it. Our competitive advantage, deep domain knowledge. I've spent over 30 years in the water sector on the consulting side. This is our second tech startup that our engineering company has launched. We know that listening to the water column is a breakthrough approach to finding leaks within water systems. We already have a patent in place. We're applying for 2 additional patents in Q1 of this year. We have a brand that's getting known in the space and trademarks in place for our name and our brand. We use trade secrets to protect our software. We're not putting that out in the public domain. But some of the unique product features I want you to leave with: plug and play, all pipe materials. We can detect over long distances. So when you ask about our team, Tim Southern's myself, CEO and president. Board member Dennis Muty, founder of C3 Water, a hydraulics and water distribution company. Don Plouffe, the inventor, over 40 years as an operator in water systems. Dr. Shriyam Narasimhan, who's worked with us at the University of Waterloo and now at UCLA. Dr. Stan Fong, our CTO and AI inventor. And as you can see, we also have our sales team started and our finance team in place. We also have outside advisors that are helping us. Sean Irving is an angel investor. Elena Pavacci is an AI expert in the electrical utility field. Jason Jones is helping us with market research, and Jeff Addison is a fund manager. In terms of our financials, basically originally we went to market with a CapEx OpEx offering, and now we're going to market with a data as a service offering. This is allowing us to increase our recurring revenue on an annualized basis by over 11 times from our current model. We're really excited about the possibilities moving forward here and the add-ons that we can bring to our platform that can increase those revenues. In terms of use of funds in this round, obviously for us in Canada, we look at the US as a large marketplace. And so we're looking to expand upon our installations in Atlanta and Milwaukee. Our primary target will be around the Great Lakes, mainly because they're easy to access for both our installers to train new installers in the US and for our sales team to reach. We're going to be growing our technical team and our marketing team. And at the same time, we're looking to enhance our manufacturing process. We already know that with volume, we can realize significant savings in the cost of our devices. So today we're in the middle of a seed round, looking to raise $1.5 million Canadian. We've already raised 20% of that to date on a pre-money valuation of $4.5 million, and we're offering common shares as the investment equity. Again, Tim Southern's Digital Water Solutions. Happy to take your questions.
Right, thanks, Tim. Martin, what's your first question there?
Well, Tim, thank you for that. And I didn't mean to, dish the whole government thing. There's kind of no other way to sell what you're doing. And you're obviously very passionate about this, and you've come up with something which is a unique and differentiated way to solve a fairly big problem. And frankly, your valuation and the amount of money that you want to raise is reasonable given the stage that you're at. My point is, and I would be happy to put my thinking cap on, there are investors who specialize in this kind of thing. My point is, I'm not that investor. There are other investors, maybe some. Are there climate benefits to this? Like, I have a friend that just raised $100 million climate fund, and he wants to do infrastructure type investments like this. This could fit into somebody with a climate portfolio. And there are VCs that specialize in water. And what you're talking about in water is a meta trend that many that some VCs are certainly looking at. It's just not me.
Yeah. No, thank you for that, Martin. And yes, there is a clean tech side to this with the GHG reductions due to the energy savings. So thank you for that point, right?
Yeah, yeah. And I think you're doing something really interesting and useful. How long have you been at it?
So we incorporated the company in 2018, and we started hiring full-time staff in 2021.
Okay. Yeah, and that goes to my thing, is that these things take kind of a long time to do. What are your with $1.5 million raise? What do you think? You're basically pre-revenue now, maybe a few paid pilots, but what do you think your revenue gets to? With
yeah, sure. So our revenue
runway give you?
Yeah, our revenue last year was $500,000, and then we're projecting revenue of about 1.3 this year. Our first quarter was just under 400,000 in 2023.
And what are your margins on that? I didn't see any unit economics in yours.
Yeah, no, we're still not profitable, Martin, on that.
Well, but I mean, what are the
margins
of a contract? Like, you install X number of these things, and there's hardware cost, and then you have a subscription service. I mean, what's your average customer contract value and margin?
Yep. So average contract value, initial contract's about $50,000. Our margin on the hardware is 25%, and our margin on the recurring stream is about 40%.
Why is the margin on the recurring stream only 40%?
Mainly because we don't have enough customers yet to leverage the cost of the cloud, like the Azure stack.
I would expect recurring revenue to be like 90% margin business.
Yes. That's so yes, Martin. And when we run the numbers, as it grows, obviously, a lot of the costs that we incur monthly for the stack and that will get spread over a much larger base of customers.
Okay. Okay. Well, those are my questions about the unit economics and how far your runway gets. If you can raise at 1.5 and get to 1.3 in revenue, you're basically a 1-to-1. That's a number a lot of VCs look at. Like, I give you so much money, how much revenue do you create? If you create $1 of revenue for every $1 of investment I give you, that's actually pretty fucking good. Most companies don't do that. Most companies would raise 1.5 and get like 500,000 in revenue. They would get like a 1/3, right? So you're actually doing better than most.
I appreciate that. Thank you.
Great, thanks. For those in the audience, we sent you a poll that if you would like to get information about Digital Water, or you want to contact him, go ahead and vote there, and we'll connect you with him. After you finish that, we'll send out the poll for Martin Tobias, Incisive Ventures. So if you want to get information, you're interested in investing or what have you, go ahead and put that in there, and that will let us connect you with him more efficiently. That's my fault. I should have called that out a little bit earlier in the presentation, but we'll capture that information here right now. And want to thank Tim for his presentation. With that, let's move to Nancy Guo of Sostos. Nancy, if you go ahead and share your screen and kick off. We can see the screen now. So whenever you're ready, we'll start the timer and we'll go through that.
Great, thank you. So my name is Nancy Guo. I'm a professor at West Virginia University. I obtained more than $45 million federal funding as principal investigator, project director for technology and infrastructure development for precision medicine. When I was a PhD student in computer science, I received funding from Microsoft and Oracle. I founded Sostos to commercialize our technology to improve cancer diagnosis and treatment for significantly life-prolonging outcomes. I'm sure that cancer has touched you or someone you know. My aunt was a never smoker and died from lung cancer in her 40s. Non-small cell lung cancer accounts for 85% of lung cancer cases and 80% of lung cancer deaths. Most stage 1 non-small cell lung cancer patients receive surgery only, but more than 40% of stage 1 non-small cell lung cancer patients will die within 5 years because of tumor recurrence. Currently, oncologists do not know which stage 1 non-small cell lung cancer patients need chemotherapy to prevent tumor recurrence. Our cancer treatment optimization solution is based on our cutting-edge proprietary AI technology, originally funded by the National Science Foundation and NASA for satellite system reliability assurance. Our AI technology is superior to other existing technologies in computational efficiency, scalability, and accuracy. Because of the competitive advantages of our technology, we received prestigious federal awards from these sponsors to analyze patient genomes to improve cancer outcomes with precision diagnostics and new regimens. Our platform technology enables personalized cancer care throughout the patient journey, from cancer screening on liquid biopsies or single cells, diagnosis, prognosis, treatment selection, to new drug options for patients with failed prior therapies. The global cancer biomarkers market is growing at a compound annual growth rate of 14.3%. We estimate our revenue based on $4,000 per test times the total number of new patients per year. $4,000 per test is a conservative estimate compared with other similar products. For cancer prognosis, we think it's reasonable to start with a small part of the non-small cell lung cancer market initially. The annual revenue is $77.6 million in the first 3 years, which is about the revenue of testing 10% of the US non-small cell lung cancer new cases per year. We'll start with our network of oncologists as early adopters and enhance our product adoption with FDA approval and presentations at top-tiered oncology conferences. When we expand the market segment globally, the annual revenue will increase by 10 times, and the trajectory will keep rising depending on market penetration. Overall, there is a much larger market of global breast, lung, ovarian, and colon cancer cases, which we hope to capture, and our patented products should be a good fit for. The cancer screening market is much bigger, given the eligible populations for lung cancer and breast cancer screening. Using our AI technology, we develop a 7-gene assay, CATOS-LU, that predicts tumor recurrence or metastasis in 1,600 early-stage non-small cell lung cancer patients. Using CATOS-LU, we can stratify patients into high risk and low risk of tumor recurrence. The predicted high-risk patients need specialized therapeutic interventions to improve survival outcomes. These are our patient stratification results using CATOS-LU, including clinical trials, with our predicted high-risk patients having a reduced survival rate. This is important because our predicted high-risk patients survived much better when they were given chemotherapy. On the other hand, our predicted low-risk patients survived worse when they were given chemotherapy due to the side effects. So CATOS-LU also predicts which non-small cell lung cancer patient has a survival benefit from chemotherapy. Oncologists need our assay to determine which patients should receive chemotherapy and which patients should not receive unnecessary chemotherapy. These are the clinical validation results of CATOS-LU in analyzing more than 1,600 patient tumors using various clinical testing platforms. KATO's LU can also improve cancer screening, achieving 94% of overall accuracy of detecting lung cancer. Our assay can reduce unnecessary surgeries and biopsies on patients who do not have lung cancer. Once non-small cell lung cancer patients are diagnosed and determined to receive adjuvant therapy, our gene assays can predict which drugs the patients will respond to, so they don't waste time, money, or suffer from the side effects of the drugs they will not respond to. Our assays can predict response to 21 drugs used for treating non-small cell lung cancer. This actionable data can help oncologists select the drugs that will benefit the patient at all cancer stages. Based on our identified genes, our AI technology discovered new drug options for treating lung cancer. The safety profiles of repositioning drugs are well established, so we can bypass preclinical studies, phase 1 clinical trials, and directly enter phase 2 clinical trials for FDA approval. One of the compounds we discovered and patented is pepperlangumin, which is a natural compound extracted from pepper that could be medicinal food, which has a totally different regulatory pathway and market. Compared to other competitive products, our gene assay is only one that works on various clinical testing platforms. It predicts lung cancer risk and the risk of tumor recurrence. It works across non-small cell lung cancer subtypes and stages. All gene assays need to be either FDA approved or CLIA certified for commercialization. KATO's LU is currently under FDA review. The agency classified our assay as a novel technology and facilitated our engagement with payers. Our assay has been validated by CAP accredited laboratory capable of performing high complexity assays. CLIA certification can be completed in 1 year to enable sales. Once we gain traction on lung cancer assay, our next step in the commercialization plan is to use our platform to develop these assays for breast, ovarian, and colon cancer. We have 3 awarded patents on breast and ovarian cancer, and 7 pending patents on our AI technology and products for lung cancer. We have raised $6 million in federal funding to develop our products. We're currently seeking $0.5 million to pursue FDA approval and CLIA certification to enable sales of our lung cancer gene assay for generation of new patient datasets and software product development. In 2024, we plan to raise $3 to $6 million to complete a prospective clinical study to support reimbursement and market expansion. This is our planned funding composition and our pending and planned non-dilutive funding applications. We have been contacted by the National Science Foundation for the partnership of industry application grant application. It is highly likely that will be funded. We expect to generate revenue through sales of gene assays, dataset software subscription, health analytics services, and licensing of our drugs. So for each KATO's LU, we'll charge $4,000 per test. The proprietary patient database datasets with whole genome sequencing data will be $200,000 per set, and our software prescription fee will be $1,000 per month. And we'll also provide R&D analytics services. For the patented drugs, we'll charge 1 to 10% of royalty fee to big pharma who will license our products. So we're currently discussing with 9 biotechnology companies with 6 NDA signed or contract under discussion to license our software, datasets, gene assays, and drugs. Our Chief Business Development Officer has 30 years of industry experience with executive roles in Thermo Fisher, Siemens, and Abbott Laboratories, among others. Our Chief Technology Officer has a PhD in computer science and will be responsible for software development, software product development, FDA package submission, and health analytics R&D contracts. And the laboratory director will conduct CLIA certification to enable sales. I founded SoSTELS and formed an advisory board for business development and a clinical board for product development. clear certification, and clinical studies. Our team contains world leaders in creating cutting-edge cancer treatment and are experienced in entrepreneurship. These oncologists are world leaders in thoracic oncology, and we co-developed the assay, and they will be our early adopters to commercialize the assay within their hospitals. SOSTOS enables optimal treatment selection for better breast, lung, ovarian, and colon cancer outcomes. Our exit plan is acquisition of IPO with 100 to 1,000 times ROI. Our platform technology and clinical validation results, including clinical trials, have been published in 58 journal papers. The FDA classified our gene assay as novel technology. Our initial product, the lung cancer gene assay, can be commercialized in 1 year. The revenue forecast is $77.6 million in the first 3 years. Our product is insurance reimbursable. We have contacted the American Medical Association for the CPT code application. We have excellent downside protection with our platform technology and software products. So with that, I'd be happy to take questions.
Great, thanks, Nancy. Martin, what questions did you have about it?
Cool. I do like the area of novel oncology treatments. I invested in a company in Dubai called Mango Sciences, which is analyzing health records in India to target better drug deployment for novel oncology drugs. I like this category. I have a couple questions. I just recently took a GRAIL test. How is this compared to the GRAIL test?
GRAIL test, I'm familiar with GAIL test for breast cancer. I'm not so familiar with GRAIL test. Can you, what is
the GRAIL test is a blood test. It tests for 50 different biomarkers. It's not a genetic test. It tests for the blood things like cytokines and things like that, evidence of tumors. It tests 50 different tests. It's $1,000 test.
Okay, so our test so far, we're focusing on lung cancer. So although we have patents on breast cancer and ovarian cancer, so far their prototypes yet is not next in the line as product development. So,
but how do you compare these, genetic based tests or versus things you can find in the blood? I think those are two different approaches to discover cancer. You're trying to figure out risk profile, but epigenetics can change how the genes actually are done, are expressed. And the research, I mean, I'm not a specialist in this kind of thing, much more about this, but I have been told by doctors that I know that they prefer blood tests over genetic tests because you're actually finding things in the blood that prove there is or is not cancer there versus just trying to gauge a risk potential for it. I mean, how do you think about that?
So our test for the lung cancer test, when we do cancer screening, it will diagnose the cancer specifically for lung cancer. And once a patient has lung cancer, and then it's going to predict whether the cancer will come back. So the GRAIL test, if it's based on inflammatory biomarkers,
it is.
Is that a risk prediction? It's not. It may not necessarily be a diagnostic tool.
It's not. It doesn't predict risk. It predicts it determines whether there's a presence.
Okay, so then our test is currently is ready to go to market is for when patient actually is diagnosed with lung cancer, although in early stage. Our test can determine whether the tumor will come back, will develop recurrence or metastasize to a different part. But we do have the data showing that this test can be applied in a liquid biopsy like a blood to determine whether there is presence of lung cancer. So far we haven't expanded to other cancer at this point. So the GRAIL test, that's specifically for a particular cancer or any cancer?
It detects 50 different cancers, and I don't know the name of all of them. I have the report. Basically, I don't have any of them. So
yeah. So currently, I think that this is a we differentiated from this product. Currently, it's under FDA review for treatment selection for early stage lung cancer patients. Although they're diagnosed earlier, but still our product will determine whether the tumor will come back and which treatment is best for this particular patient.
Well, it sounds like a novel approach. It's great that you've had lots of, federal funding, and it's great that you're in the pipeline for FDA. There are VCs that specialize in this kind of drug discovery and FDA approval. That's not me.
I think it's you, because I show here, I didn't have a chance to give you a demo, but this is our software app, and this does not include FDA approval. I know we're running out of time, but we didn't have a chance to show this. I didn't know you were in the audience, so this is a different pitch, but we do have the products. If you're interested, I'd be happy to show you the demo and see how it reduces the friction in oncology's pipeline.
Okay. All right. Thank you.
Thank you.
Great. Well, that's the end of our time today, guys. Thank you, Nancy, for your presentation. Thank you, Tim, for your presentation as well. And Martin, especially want to thank you for your pitch and presentation and asking great questions. We will connect everybody based on the polls and what came through the chat box today. I want to thank everybody for joining us today, and we hope to have follow-up discussions afterwards. So with that, we'll go ahead and wrap up. Thanks so much, guys. Have a good one.
Thank you. Have a good day.
Thank you.